Okay, so we're keeping a very close eye on EURGBP for a potential sell tonight. This trade idea is based on a confluence of reasons, and we're going to go through them right now. We've got price action at this moment in time in the formation of a bearish pin bar reversal, rejecting this soft level of resistance here. As you can see, it's tested multiple times ever since the beginning of March. This year it's only broken it once, and we can see that price is within a range here, a medium-term range, and whenever we get a range-bound market, it makes abundant sense to sell the top of the range or to buy the bottom. And as we're in a predominant downward trend here, we've got good order angle and separation between the 200 moving average, the 50 and the 20, so that's a sign that the sell bias is still well and truly entrenched. Aside from that, we've got bearish reversal divergence as well, so we can see here that while price has made a unique high today and rejected this level of resistance quite abruptly, it made a unique high today compared to Thursday, where it made a high which has been exceeded today, but compared to that the RSI has made a lower high. So wherever we get price making a higher high but the RSI making a lower high, then we've got that disagreement. Then that's a sign that the momentum of the buyers is getting a little bit well, it's diminishing in strength, and we can see that sellers are potentially coming back into the market. If we look on the hourly formation as well, we can see here that we could potentially see the emergence of a double top formation here on the hourly formation, which has spanned over the course of 3-4 trading days. And if the conservative trader does trade this by simply placing their entry below today's low, minus spread minus that additional pip, with their stop loss above today's high, plus spread plus that additional pip, then by the time it comes down to test the neckline of what could potentially form as a double top on the hourly, then at least a 1-to-1 potential reward to risk has been made. Okay, so tentatively, if we say we've got a distance of 65 pips difference between our entry and our stop loss, and about 65 down or pips difference between entry and the neckline of this, what could potentially form as being a double top formation, then that's a 1-to-1. But of course, looking at how this range has performed over the past few months, we can reasonably say that the bottom of the range would be a more likely target, as we've seen price test this bottom of the range, this level of support here, just above 0.7050. We can see that if we do go to a slightly more aggressive target, even if it's not quite to the bottom of say 236, 236 pips divided by 65, that's a decent 3.6 to 1 reward to risk trade. Okay, so the conservative trader, what they'll typically do is they'll place their entry below today's low, minus spread minus that additional pip, with their stop loss above the high, plus spread plus that additional pip. And what they'll do is that they'll wait to be triggered into the trade, so they'll place their orders after 10 o'clock PM tonight, London time, and given there's not really much movement in the market overnight, it's very unlikely this trade is going to be triggered. But if it's not triggered within 24 hours, i.e. if it's not triggered by 10 PM on Wednesday night, then that's a sign that there's no real downside sentiment with this trade. Okay, so the orders will be deleted. If the trade is triggered, then what the conservative traders will typically do is trail their stop loss above the high of every second seller bar if they wanted to be aggressive in their stop loss management technique, and that's typically a good compromise between banking profit and giving the trade enough room to breathe in the course of retracement. Some traders might just like to set their orders up and forget about them, move their stop loss to break even once they're 65 pips in profit, and just wait for an all or nothing outcome. If their profit target is hit, then fantastic. If it's not, then at least they've moved their stop loss to break even and they lose nothing. But as it's a reward to risk of 3.6 to 1, that's 3.6% potential gain risking 1%. That's not a bad reward, and we do have an additional clue in support of this. And as we're going short on the euro and going long on the British pound, we can see here on equity clock that, okay, traditionally over the past 2 decades, euro has fared pretty flat in June. Look at it, it's just moved sideways based on the aggregated data of the past 20 years. And this is from equityclock.com, which is a very good free resource which shows us typically how currencies have performed throughout the seasons. If you compare this to how the British pound has typically performed over the past 2 decades, then we have a slightly different story here. There, throughout June, we've seen the British pound rally after an initial fall in the first week, and it's rallied traditionally throughout the second week of June to the beginning of August, where we see a steep decline. Okay, so we've got that divergence. This is very good for our cross pair Euro GBP, because we are looking essentially to go short on Euro and long on the British pound. Okay, so that's another clue in favour of this trade for a sell. Of course, it might not work out. There's nothing guaranteed in the market. Markets can do anything at any time. Okay, but as technical analysts, we're looking and gauging at probabilities here in support of a trading outcome.